I've actually had a lot of questions about why do interest rates affect stuff? Like, why does that affect housing? You know, what I don't understand. This concept seems a little bit foreign to me, and so I told myself next stream I would actually go over this. So let's go over this really quick. Here's the question. The question is, why do interest rates affect markets? That's kind of like the big picture question. So let's look at a scenario. Okay, so let's say you guys all want to buy a house, or maybe you own a house or whatever. So let's use a house for example, and then we'll kind of snowball that into how this works with businesses and like commercial loans and stuff like that. 250K mortgage or let's say home. And actually, you know what the average price home right now is? $400,000 nationally, $400,000, which blows my mind. You guys might not know what K means. So $400,000 home. Okay. So in the first scenario I, rate is 3.25%. So this is what rates were, you know, a couple years ago, or maybe even like 1 year ago, I guess. I refinanced my house at 2.75, something like that. Today, rates are over 7. So let's say rate is 7.0%. So calculator.net, you can say, okay, what's my loan amount? Well, my loan amount is, let's say you're 100% financing, whatever. You maybe the house was 440,000, sorry. You put 10% down, you financing 400,000. So you're going to finance it over about 30 years. And, you know, what did we say? We said 3.25 for the first scenario. 3.25 says that 1740. So your principal and interest payment is 1740. All right, P&I 1740 a month. Okay, which you can afford. You're actually very excited by this. You're very excited because you can afford 1740. Like exactly. You got a nice job. You and your wife combine your income or whatever the story is. You got enough money, you can make that payment, you can make it work. Okay. But unfortunately, you know, life happened, you were in the hospital, you got hit by a car, whatever, and you were delayed a little bit. So now you had to delay closing. You're about 9 months behind, and now you want to close. So the bank has to use today's rate, right? Like it's like their thing. So what are you paying now? You're using $22,661. That is your new payment. Nothing changed except the interest rate. $2,661. I'll call it 50%, 50 something percent. So this is an increase of what you're paying just for principal and interest has increased by over 50%. Okay, so how is this affecting our greater market? Isn't that wild? This is the reality of like this situation where we're at. So I try to present this information in a way that like maybe you know make more sense to you. We're talking about homes, home purchases, whatever, but replace home for building, commercial building. And now, you know, your mattress firm or whatever the hell, Starbucks, they wanted to buy that $400,000 building to run their business out of. But here's the difference in expense. Where are they going to get this? I mean, we're already seeing some of the effects because they're increasing the cost of their stuff. The Starbucks coffee is increased. The mattress goes up a little bit. The steak at the market goes up. You know, we're seeing how these things roll into the economy. It's not just like, oh, well, you know, we'll just increase the cost and everything's fine. While costs have increased to partially offset this stuff, there's not enough demand at those new cost levels. You know, you look at a chart and the like most optimum price is where supply meets demand. But as you start going up on the cost of a thing, there's less demand at those levels. You know, it's the same concept for a Bitcoin. There was significant demand a year ago at $70,000. Today there's not, so it's here at $20,000. Unfortunately, these guys have mortgages and they can't just drop the price of their thing willy-nilly like that. So it's a very, very interesting conundrum. And oftentimes the net result is not enough people, there's not enough customers to offset the new OPEX, the new operating expenses that commercial businesses incur, and therefore they go under. So these are the times when things go from bad to worse. and they get really nasty really quick. And this is why I think it's so funny. They think it's so funny that somebody sent me this because they saw it and they said, homie, this reminded me of you. And I just had to get it to you. Let me make it show up. It gets worse before it gets worse. And I think that's great. Because that's the reality of this current market. It sucks. It sucks, but that's where we're at. This is, and I just want you guys to understand why every time interest rates go up, it's squeezing more on the economy. It's just that much more. And until we get out of this, we have never had a recession end until after rates have stopped going up. This is a historical fact. This train doesn't stop going down until interest rates stop going up. And in most cases, it doesn't happen until they start going back down again. So, we need rates to go up. We need them to coast and then start coming back down again. We're not even to that part. How far can interest rates go up realistically? Well, they put out a thing today that says they're nowhere near done, but they probably won't do 75 basis points or 3/4 of a point going forward. They'll do like a half point. Well, a half point still a load over multiple meetings. So I bet it's not until 2023 that they're done doing this. My wife is a loan officer and people can lock in the rate for $500. She says no, and they're ready to move forward. They can't afford the new rates. I know. So think of banks, right? So banks make money off people making new loans and refinances. Nobody's refinancing their stuff right now. Nobody's getting a new loan. A year ago it was 3%. Today it's 7%. Get out of here. Like, you're trying to screw me, bank. That's what people think. Because banks already kind of have a bad rap, But that's not the reality. The banks are literally charging like a certain number that they borrow money for a certain cost and then they pass it on at another. It's not like they get free money infinitely and they can just pick a number. So yeah, in the 80s they were 18%. I know, who knows, man. So I don't know where rates are going to end, but all I'm saying is bringing it back to the Dixie. Every time rates go up, the Dixie tends to show strength. At minimum, let's just say that we just do this. Let's just kind of agree that we do this for 6 months, and then we can all kind of leading into 2024. I don't think we have a bull market until 2024. I'm just being honest. I've said that for a long time, and that's not just some BS number. That comes from, where the suspected fourth halving is, and I'm a big believer that you get a halving, you get a bull market. You get a halving, you get a bull market. You get a halving, you get a bull market. You get a halving, you get a bull market. I don't care if we're down here. I don't care where we are on the chart. I still think a supply shock on the other side of all the scary stuff. Like, we're in the scary stuff right now. This is the kind of the crappy times. No one wants to trade. No one's really making money, guaranteed. If they say they are, they're lying. But this is just all chop trades and stuff. I'm not trying to be perma bulljack, perma bearjack, just charts jack. Just whatever the charts are telling you. That is all I'm good for. That's all I'm here for, and nothing else. I'm not your hype man. I'm not your bear guy telling you to sell.